Are you sick of people profiting off of disaster and catastrophe? I want to do the opposite. I want to make money when the skies are blue and nothing bad is happening. I'm going to invest in disaster and catastrophe insurance. When nothing bad is happening, these companies are making a lot of money because they are collecting premiums, and it's only when disaster strikes that they have to pay out. Is this all mental gymnastics to justify investing in insurance? Yes. But is it a profitable investment? Let's find out. What's up, y'all? It's Brian. This is my YouTube public portfolio series, where this latest rabbit hole in disaster insurance actually came to me through a commenter on one of my videos. Manustro, I hope I'm pronouncing that right. Hey, Brian, love the videos. I don't want to spam you, but would you consider doing a video on HG? So I thought, yeah, sure, I'll check it out real quick. I went to my handy dandy intrinsic value calculator and it looked pretty good right off the bat. So I thought, hey, maybe I'll do a little bit of a deep dive into insurance because this company looks, on the surface at least, that it's incredibly undervalued right now. But first, let me do a really quick recap of my YouTube portfolio as it stands today. Currently, the portfolio is up $70 despite the latest bomb that Trump dropped on Friday about widespread tariffs on other countries. So we'll see how that goes on Monday. But currently, we're still up. The majority of my holdings are down slightly. My biggest wins right now are HIMS and Zeta, while everything else is down slightly, and Crocs being down the most. Although I can't really see much reason why Crocs would be down so much. I need to do a deep dive on this company again and see. Maybe they have a lot of stuff that they're importing, and so they would be subject to tariffs. So with HG, Hamilton Insurance Group, their current share price is $18.89. When I go to my spreadsheet, I am showing the analyst low projection is worth $20. Using the analyst predictions for future revenue and the past free cash flow margins to estimate the future free cash flow, and then performing a discounted future free cash flow model to calculate the estimated intrinsic value of the company. So if the lowest projections are correct, then that would put the stock price at $20, meaning this company looks to be incredibly safe. Now, the analysts did not predict all 5 years of the future revenue projections. They only projected 2025 and 2026 for some reason. So these cells in white are actually my projections. So it's analyst projections and Brian projections. So let me show you how I came up with these. First, for 2024, when I go to Hamilton Insurance Group, I go to their financials and their income statement, I can see that the trailing 12 months, so this ends in September 30th, whereas normally the fiscal year goes from January to December 31st. So this is from September to September. They had a 69% growth in their revenue. Now, it is possible that in the fourth quarter of 2024, it's a disaster and they lose a bunch of money. But if they continue at the same rate that they have been for the last 12 months, then they are set to have a huge revenue growth in 2024. So going back to the spreadsheet, you can see that's where I came up with the analyst high projection. I went ahead and put 69% in there. For the average, I just pulled this one out of my butt, 30%, and then the low, I made it 0. So I wanted to create a nice spread of values. And then for 2027 and 2028, I show it tapering off, approaching a 3% revenue growth rate, which is the long-term future of the company, assuming it doesn't die, is growing their revenue with inflation. So here, this graph shows the spread of revenue that could take place according to the analysts. The red being the highest, that would mean the share price today should be $42, which would be a 2x increase. And the average is 29, which is a nice 50% increase. So this company looks really strong. And then I noticed that their free cash flow margin took a massive dip in 2021. So this is a huge anomaly. I have to look into that because that huge dip is bringing their past average free cash flow margin to 3.42%. So when I go to their financials and I look at their free cash flow margin for the trailing 12 months, 22.5. 2023, 18% margin, 15% margin. And then they had a big loss, 17% margin, and then 0% margin. So it looks like if I ignore that horrible year, the average might be closer to maybe a 15% free cash flow margin. So if I boost their free cash flow margin by 12%, that brings their intrinsic value projections way, way high. We're looking at massive potential gains here. Now, I was really tempted to do this because a lot of times with a company, if I see an anomaly, I will exclude it from the projection. However, in this case, it feels wrong to exclude big anomalies because they make money when there are no catastrophes. So if I go back to their past and then I cherry pick and remove all the catastrophes, of course, it's going to make it look like their business model is really, really good. But that kind of defeats the purpose. There will be catastrophes. So I feel like I need to leave that calculation in the model. So I really don't want to mess with their free cash flow margin. I'm going to leave it at 0, even though on average, 3.42 might be a little overly low. This company still looks like a really good steal right now. I'm still looking at 50% gains if the average revenue projections take place. So according to the free cash flow analysis, Hamilton Insurance Group looks like a great investment. However, I have to admit, I've never invested in an insurance company before. So I don't have a lot of perspective when it comes to this type of investment. I need to do some comparisons. I need to look and see how do other of its competitors perform compared to HG. When it comes to investing, there's always going to be an element of risk, and I don't know the future. So the best I can do is show you how I come to the conclusions that I come to, and then you can take that information and make your own decisions. My goal is to get you to think critically, not just blindly follow what I'm saying. The best way to understand what does this company do and how good are they is to first go to their SEC filings. So namely, I want to look at their annual report where they talk about their business overview and all of the information about their business. So on Google, I just typed in HG SEC filings, clicked on the first link, and here I can see the latest 10K. 10K is the annual report. 10Qs are the quarterly reports. So when I click on that, I don't have to scroll down very far to find their business overview. We are a global specialty insurance and reinsurance company. So let's start there. What exactly is specialty insurance and reinsurance? To find the answer to that quickly and efficiently, I love to use ChatGPT. I mean, ChatGPT is just a wealth of knowledge. I mean, we are living in a time now where information is no longer scarce. Anybody can acquire knowledge. It's all on the internet. And now we have pretty intelligent AI that's capable of just reading all of it and then synthesizing it down, saving us tons of time. I started using ChatGPT when I saw an article that showed that ChatGPT 4.0 is on par or better with professional financial analysts. So why would I not utilize this resource? I asked it to summarize for me what is reinsurance and specialty insurance. And basically, reinsurance is where an insurance company wants to take some of their risk off the table and they spread their contracts out to other insurance companies. And then specialty insurance is higher risk, high reward, more complex underwriting, aka disaster insurance or catastrophe insurance. In this case is one of the big ones that Hamilton Group does. So the next thing I really wanted to understand is what do their competitors look like? I want to compare their competitors' numbers to the Hamilton Group numbers. So what I did to find that is on their annual report, I just typed in competition to see if they would show a list. And sure enough, they do. Right here at the bottom, they give me a list of all their competitors. So I typed that list into ChatGPT to synthesize that information quickly. Okay, so into ChatGPT, I've just pasted that list of companies. I said above, I listed several insurance providers. Which of these companies are publicly traded on the New York Stock Exchange or the NASDAQ? Had to go back and forth with ChatGPT a little bit to get I had to adjust the list so that it ordered it by market cap. And then I had to ask ChatGPT to use stockanalysis.com specifically to get the correct market caps. And I finally arrived at my list. What I did here is I took the two largest, ARC Capital Group and Markel Group. These are the two biggest market caps. And then I got three other companies that are similar in size to HG. HG is around this size right here. So I grabbed the Hanover Insurance Group, Palomar Holdings, and Skyward Specialty Insurance. So real quick, if I go back up to Hamilton Group and go to the overview, I can see that the market cap is about 2 billion. Go back down to my list. I grabbed these three companies right here that are around 2 billion. The Hanover Insurance Group is 6 billion, but it will do. Now that I have my list of competition, I need to understand what are the key measures or the key metrics that I need to use to compare these companies. So back to HG's annual report, I looked at their key operating and financial metrics. And the ones that made the most sense to me in this list is first, the underwriting income or loss. So an insurance company, basically it starts off as a huge sum of money. Once you have a huge sum of money, it gives you the ability to become an insurance company because when you're an insurance company, you collect premiums from people, but then when something happens, you have to pay them out. So you have to start out your company with enough money so that you have the ability to pay people out. Hamilton Insurance Group, they have this massive portfolio collecting premiums along the way. And their investment portfolio is also creating gains for them. I kind of like to look at it in two separate parts. What are their investment gains? And then what is their actual underwriting income? Do they actually make money at the end of the day? Because these companies can still show profits even if their underwriting is losing money every single year, as long as their investments are creating enough value for them. But I'm not investing in this company because they're like a good hedge fund. I'm investing in them because they're able to create more value with their big portfolio by underwriting. Okay, so underwriting income, that's one of the key metrics. The second key metric I like to use is the combined ratio. This just tells me what percentage of the premiums are they actually keeping as profits. So if the combined ratio is above 100%, it means the expenses are greater than the premiums. And if the ratio is below 100%, then they are making money. So that is good. The next thing I did is I took these 5 companies and I compiled this data into an Excel sheet so that I could quickly and easily compare these companies. This first chart here shows the underwriting income. HG is by far the most profitable in terms of underwriting income, but they are also the biggest company by market cap on that list. So it's kind of hard to look at the rest. So for this next graph, I just took them off of the chart so I could get a better look at what's going on right here. Our boy HG, this is the one that we're trying to see if it's a good investment. That is in blue. As we can see, they've lost money every single year until 2023. They've lost money on their underwriting. Now they have been trending up the whole time, and they are right there with MKL, which is the second biggest by market cap. So they are now generating some pretty good underwriting profits. However, they've been negative in the past. So that is important for me to understand. Next, when I go to the combined ratio, once again, if it's above 100%, that means they're losing money. If it's under 100%, they're making money. So that is consistent with the blue again. HG had over 100%, but it has been trending down. And now they're at 90%, which is in the middle of the pack. They are trending towards profitability. They're not the best in terms of profitability on their underwriting, but maybe some of these companies have other forms of underwriting. Maybe it's not all disaster insurance. Maybe there are other types that have a different typical combined ratio. So the next thing I want to do is look at a breakdown of some of these other companies' combined ratio. So the fact that this company has not been profitable in the past might explain why it's trading at such a huge discount right now. Now, this company has only gone public in 2022, so they have not been public for very long. So this data prior to 2022 is from when they were a private company that they released in their S1 disclosure when they went public. Now, they have had a lot of changes since 2019. In 2018, HG appointed a new CEO. So they had a management change. And then since that management change, they have been trending in a very good direction. So to me, that looks pretty convincing that this CEO, Pina Albo, is doing a very good job bringing this company into profitability, which I like to see. The final chart here, which HG did show as their key financial metrics that I did want to point out, is the price to book ratio. I found this one really interesting. So on the price to book, the way this is calculated is you go to the company's balance sheet on their financial reports, you look at their total assets. This is the amount of cash and property and all the stuff that they have, all their assets that they have or money that they're owed. And then if you subtract that by their liabilities, this is the money that they owe to other people, you get a shareholder's equity, the total assets minus the total liabilities. The shareholder's equity is considered a company's book value, the amount of money on the books. Now, there's more to a company's real value than just what is on the books. This company might have lots of very profitable relationships that give them access to business. Maybe they have very good people that work for them that make them very profitable. So the book value isn't everything, but it is something that a lot of people see as a minimum to like their share price, what their share price should be. So the book value of HG is 2.37 billion. However, when I go to their market cap, this is the share price multiplied by all of the shares. Their market cap is only 1.92 billion. Their share price is less than their book value. So what this tells me is that the market is saying this company is going to die someday. Like this, it's priced as if it's going to eventually go to zero or never grow or shrink from here, which doesn't really make sense to me, especially when I look at the financials and I see huge revenue growth year over year. Since 2020, they have had massive growth. They started at 700 million and now they're at 2.2 billion, 92% growth, and then a loss in 2021. Of course, we know what was going on in 2020 and 2021. There was quite a few disasters, namely COVID. 2022, 59% growth. 2023, 28% growth. Last 12 months, 69% growth. I'm just not seeing a company that's dying, especially as they're getting more and more profitable. So when I compare the price to book ratio for Hamilton Group to the other companies of its competition, I see Hamilton Group is way lower than everyone else. I see price to book ratios of 4.16 at the highest. That means the share price is 4 times more expensive than the book value of the company. So people are paying a premium for these other companies, but HG is at just such a discount right now. The final information I want to show y'all is from their investor presentation in September 30th of 2024. If I scroll down to the bottom, I think this chart just really underscores the direction that Hamilton Group has been going since their CEO change. So this first chart shows Hamilton Group's premiums written every year since 2019. They have grown by 28% on average per year. And if we look at for 2023 and 2024, the 9-month period, once again, this shows continued growth. So I am expecting more growth in 2024, and their combined ratio continues to drop every year. Now in 2022, they are showing a combined ratio of 96%. But there is an asterisk here. This says it excludes the impact of the Ukraine conflict. I don't really like that. I mean, if they're insuring for disasters, to me, it doesn't make sense to exclude a disaster because that's part of your business model. But nonetheless, they excluded the Ukraine war for calculating the combined ratio in 2022. With that in mind, their combined ratio continues to drop. And if we look at the 9 months of 2023 compared to the 9 months in 2024, they are leveling out at a 90% combined ratio. If they're able to maintain a 90% combined ratio, then that means their free cash flow margin is going to be going way up past the 3.5% that we have projected so far, which puts their lowest analyst predicted share price at $20 per share, which is already a 5-10% gain on today's current share price. So is this company risky? I would say yes, it is. This is a risky business model, but it's priced so low. To me, the downside is relatively protected. It can't drop much lower, much faster unless new negative information comes out. And right now, I'm just not seeing any signs that there is going to be new negative information. Now, if that information comes out, then I will change my thinking. But as of today, the downside looks relatively low and the upside looks incredibly high. If I give them credit for just 2 more percentage points on their free cash flow margin, pushing them up to an average of 5% free cash flow margin, that puts the lowest projection at 28 and the highest at 62. And that's a 200% gain for the high, a 100% gain for the average, and a 60% gain for the low. It just has a really attractive upside. I am investing in HG. Unfortunately, the but here, I cannot invest in HG on M1 Finance. It's just not supported for some reason. So I'm going to be investing in it outside of my YouTube public portfolio series. However, for today's $100, I still need to allocate that money every week. And this week, I'm going to double down on Crocs. The share price has gone down quite a bit in the past few weeks, but there hasn't really been any change in the analyst projections. There hasn't been any changes in the forward guidance from the company, meaning this company is just even more undervalued. When I predict 0% growth, and then I look at the average analyst and low projections, the lowest analyst projections are showing 0 growth, 3.7% shrinkage, 3% shrinkage, 0 growth, 0 growth, and then I predict 0 growth into the future. The lowest projection still shows a $106 share price. So as long as Crocs doesn't die, it is on sale right now. I mean, it is $93 per share, 94 after hours. If it doesn't grow ever again, like not even with inflation, if it just stays flat, then it's still undervalued. And when I look at the financials, I'm seeing growth every year in their revenue. Going back to 2021, 67% growth. 2022, 54% growth, 11% growth. Last 12 months, it has slowed down, but one way to deal with the risk that a company might go down in the future is find a company that's already underpriced. When a company is already undervalued, the downside shrinks to much, much lower. If a company is overvalued and then they have poor performance, the stock price can plummet big time. But if a company is already undervalued, it's like the market already thinks that this company's not going to do very well. If that happens and they don't do very well, then the stock price doesn't typically drop drastically in that case. This is what's known as Peter Lynch's haircut strategy. He waits for a company that he likes to have a haircut, and then he invests in it when it's looking really good because of the eliminated downside risk and the much greater upside benefit if the company performs well. All I can say is we will see with Crocs. I feel comfortable putting another $100 into it. If you want to see the previous video where I went over the deep dive into Crocs, check it out right here. Cheers.